So, what's the deal with a budget deficit and public debt? We've chatted about inflation, interest rates, recessions, and monetary policy. Now, let's talk about the government's financial situation, like budget deficits and public debt. At the end of the day, it's pretty straightforward, so, the government's revenue and expenditure are basically the same, right? That's how you get a balanced budget. If you spend more than you earn, you're in the red. If you earn more than you spend, you're in the black. It's just like your household budget, really. So, where does the government get its money from? The government makes most of its money from taxes. These include income tax, corporate tax, sales taxes, like VAT, fuel, alcohol and tobacco taxes, fees, licenses and fines, and income from state-owned assets. So, where does government money go? Spending, obviously. The government spends money on all sorts of things, like teacher salaries, doctors and nurses, roads, bridges, airports, pensions, social support programs, security and defense, disaster relief and rebuilding. It's a bit more complicated than just rent and bills at home. So, what even is a budget deficit? Picture a family earning $5,000 a month but spending $6,000. I'll need to borrow that extra $1,000. The same logic applies to a country. If we spend more than we earn, we'll end up in the red. That means we'll have to borrow more money. But governments don't go to the bank for a personal loan. They borrow in specific ways. They issue government bonds. They borrow money from investors in their own country and abroad. They get money from central government institutions or stabilization funds. State-owned banks sometimes step in to support funding needs. Public debt is the result of years of deficits. When deficits carry on over time, they build up, and this is what is known as public debt. This debt has two parts, so, domestic debt is what you owe to local investors, banks and funds, and external debt is what you owe to foreign investors or institutions. It's just like having a bunch of loans at home, and they all add up over time. Is debt always a bad thing? Nah. Good debt is used for investment. New hospitals, rail systems, bridges, renewable energy projects, these projects are great for the economy, create jobs, and increase future tax revenues. But bad debt is basically just a way of spending money temporarily, either because it's politically motivated or just to keep the economy going before elections or when salaries are increased without thinking about the long term. It doesn't actually create economic return, so it ends up being a burden. So, let's talk about the difference between household and government debt. If you've got money problems, the banks won't lend to you. For governments, the process is slower, but the logic is similar. If you've got more debt, you'll probably have to pay higher interest rates. And higher interest rates mean borrowing will get more expensive. So, you'll end up with even bigger deficits. And that just creates a dead interest spiral. Here's an example. If a government owes $1 trillion at 5% interest, it'll have to pay $50 billion every year just in interest. That money can't be spent on education, healthcare, or technology. How deficits affect the economy. Here are some possible effects. It could push interest rates higher, reduce investor confidence, clash with monetary policy, reduce fiscal space for future crises, and become more dangerous when combined with inflation. But sometimes deficits are intentional and necessary. So, the deficit is important when the economy's in a slump, during pandemics or natural disasters, or when the private sector's struggling. Is a budget deficit always a warning sign? Not on its own. The main questions to consider are, why did the deficit happen? Where's that borrowed money being spent? But can the economy really afford it in the future? When the economy is strong and growing, it's easy to manage debt. A weak, shrinking economy struggles, even with less debt.